You're in the Business Insurance Zone with me, Steve Savant, National Insurance columnist and financial color commentator. And all this week we're talking about the post-Obamacare and Obama tax series, and today, tax relief opportunities with tax advantage strategies using layered annuities with Ken Davis, CPA.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me, day 4 with Ken Davis, CPA, CFP, ChFC, and CLU. I went backwards this time.
Yeah, hey, you're getting good at that.
I got to tell you, I'm not dyslexic yet. Okay, we've been talking about some of the impact of the Obamacare and the possible sunset provisions that could really make things interesting, and how these are huge end-of-the-year opportunities for advisors to impact their clients' 1040 tax, which is all about what you're advising. You're trying to help people pay less and keep more. I mean, that's the end game here.
Right, and let's remember our job is to help with the products that we have that have tax advantages, and ultimately it's the CPA that's responsible for the tax advice because our E&O doesn't cover it, guys.
That's right. And you know, I like to engage the fiduciary market. Generally, the CPAs that are watching our show are very favorable towards us, and they really are. Usually they say, Steve, I didn't know that. And I think that's an encouragement that we're now becoming a little closer. They're taking a second look at us. When we talk about, though, when I think about layered annuities, because sometimes we use the word combination, it's kind of actually, that's a different situation. Mm-hmm. We're doing layered annuities. We're going to kind of use kind of a strata, kind of mentality, right? Mm-hmm. Let's talk about what an annuity is. We did mention this a couple shows back, the power of tax deferral. So that's part of the tax advantaged. So let's park that for a moment. But then, Ken, talk about, when you mean layering, you mean different time or periods or durations? Is that when you talk about that?
And different kinds as well. In fact, we talked about this on our series on reduction of taxation of Social Security income. We're using the same concept now for the wealthier clients because of this new 3.8% tax and the sunsetting of the tax provisions and the increase in Medicare premiums based on modified adjusted gross income. So what we're doing is, and this is just one structure, and it can be designed to be custom. You might take a 5-year immediate annuity, and one of the reasons I want 5 years, I don't want to lock this in because interest rates are so low. I want a new fresh look for inflation every 5 years at a minimum, okay? So a 5-year immediate annuity. Now here's another cool thing about the tax law. When they amortize tax basis, it's on a straight line basis. Why is that important? Because I get a higher deduction up front than I would have on an accrual basis. And I'm not going to get into that detail, but that's how it works. So if I put $25,000 into a 5-year immediate annuity, I divide 25 by 5, and so the first $5,000 of what I receive each year is a return of my own premium or tax-free, and only the excess interest on top of that's taxable. So I have the small piece giving me income, then I have the rest of it in tax-deferred annuities, not income annuities, but deferred, of a couple of different types. And so the tax impact is very substantially good in that instead of having interest on CDs, bonds, or even municipal bonds that are adding to the taxation of Social Security or being added back in as a modification to adjusted gross income on these formulas, now I have return of basis, which doesn't impact modified adjusted gross income or taxable income, and then for that case, gross income. So the fact is I can reduce my tax brackets, the 3.8% from even coming into play, possibly the taxation of Social Security income, Medicare premiums, limitation on medical deductions. All of these things are favorably impacted by the fact that I amortize that basis over 5 years. So that's layer 1 of the cake, okay? Layer 2 is, and maybe 2 and 3, is a deferred fixed annuity. Okay, nothing fancy, real plain vanilla. And I defer for 5 years on that second layer. Then I turn the switch on that and annuitize that for 5 years. And here's the cool thing is I get to restate my interest rate at that time. So for people that are afraid like me of higher inflation, higher interest rates, I get to reset and my penalty period's gone away. We get lambasted a lot for 10 and 12 year and 14 year penalties. Well, now we're just going to have 5-year, which is much, much more acceptable and saleable, I think.
Well, but can I just make sure we're on the same page, though? We always talk about the length and time, right, and the penalties, right, for getting out. And so 5 years is, I think, a really good chunk of time.
Sure.
But I mean, the banks do the same thing. If you pull out early, you're
Sure.
going to pay a penalty. So every bank, every insurance company has to watch their bond holdings. They just can't let it just go without any surrender charges or penalties. So we're all there the same way.
Well,
That's
there's
the mechanics of econ.
Yeah, there's reasons for the penalties, and the penalties are there to allow the insurance company to invest in longer term maturities on the bond portfolio so they can get higher interest rates. So there is a good reason why they do that. Anyway, so 5-year immediate, 2 5-year deferreds. Every 5 years we turn on the spigot on those deferreds. Okay, and we get to have the higher interest rates if in fact they come. We don't know for sure, but our expectation is. And the final piece is an entirely different. We had immediate, we had 2 tax deferred. Now we're going to have an indexed annuity with a lifetime income benefit rider. So think about it, a 65-year-old person now retiring, we layer this, they get 15 years of guaranteed income. We might set it up so we have a little higher income in each 5-year increment, both from higher interest rates potentially and because we designed it that way. And the final piece is the indexed annuity with a lifetime income benefit rider. So we gave that puppy 15 years on these really nice formulas, that 6 or 7% growth factor for income, not principal, that we can turn on, and she's going to be 80 or he's going to be 80 at that point. Much higher distribution rates at 80 than at 65.
Well, I heard the official phrase for your tactic, turn on those puppies. Okay, you've heard it here in the Insurance Zone. Ken, CLU, ChFC, CFP, and CPA just called his tactic a puppy. Wow. When we come back after the break, we're going to talk more about this because it's tax deferral, it's exclusion ratio we're using, and we're using the power of really cool products. We'll be right back.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Companies in our business are always touting service, products, and underwriting. And we do that too. But here's the difference. Now enter the world of the elite producer with a value package that cuts us out of the pack. A BD that approves social media marketing of non-FINRA products and doesn't take an override. With the best competition desk in the industry, and for our loyal producers, a true group health plan. No one offers that. Brokers Alliance does.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant here with Ken Davis, and we're talking about how we're responding to the Obamacare and the possible sunset provisions of Obama. And when we're thinking about this, there is a lot of drama with Obama here. I mean, this is all about taxes, right?
Yeah.
And I mean, we're looking at 1040 impact. Ken talked about parking an SPIA at the front end of your idea, if you're layered, and then using 2 SPDAs having 2 different periods, right? And then using an indexed annuity that has a lifetime income benefit rider,
correct?
Right? But that sounds different because that is your layered approach. Tell me the distinction between that and what I would call their traditional combination approach, combination annuity approach.
The old, they might know it as split annuity or combination annuity. Back then we had high interest rates, so the idea was to have an immediate annuity for typically 10 years, use the amortization of basis, and while that's taking the, putting out the income, then the rest of it is on a guaranteed interest rate. It would grow that remaining portion back to the original. So you might have 30,000 immediate and 70,000 deferred. The 70 grows back to the 100. Well, interest rates are so low, we really can't use that old tactic anymore. So now with our new products, a lifetime income benefit rider, we're growing back not principal, but an income guarantee. Big distinction. The new one is not a cash value. It is a guaranteed income for life. So we have a base formula rate, not a cash value. So we're saying we really don't care about that because what do retired people want? They want income and they want it guaranteed. Who could get hurt? The kids.
Right.
And IRS. We're going to reduce taxation with these tax techniques.
Well, I don't mind the IRS can hurt.
Well, I don't either. And so we're going to come back and talk about other alternatives where the kids are important with life insurance. But for now, we're talking about income structures.
I was just thinking, I just had a fantasy, like, did anybody ever put down as their beneficiary when they died the U.S. government? I'm just curious. I just that you said that.
Well, it's not going to be me, I can tell you that.
Okay, and of course we're both libertines, so I guess the answer would be I as well will not be participating. When I think about this, though, I also want to bring up this issue because I remember I had Tommy Hegna on our show, and the older the client gets, the older my senior is, I may be looking at SPIAs, not because of the rate, that's for sure, but I might be looking at it because of the mortality credits. Because when you get a certain age up there, should I engage my indexed into income, or should I then look for, because we're not going to have to look at this for another 5-10 years, right?
Well, in my case, 15 years. You're going to have 15 years to let either the index do its work, which could be wonderful or it could be mediocre or poor.
Right.
But we have the option now. We can look at the index and we can look at an 80-year-old person. You know, 5-year immediate, 5-year deferred, 5-year deferred. By the time we're done with those first 3, we've had 15 years pass. So a 65-year-old is now 80. A 65-year-old is now 85. Well, gosh, that cash value turned on to a lifetime income on an immediate annuity could be very substantial at that point.
And by the way, just keep that in mind, because the older we go up the timeline on the client's age, we have to look at both to see which one's going to deliver the numbers. Now, again, remember, in these scenarios, the beneficiaries lose out a little bit on this, because really we're taking lifetime income, right? We're trying to get the mortality credits. I mean, the last time I looked at the IRR, but if you do this joint, this is just Steve talking about, if you do joint annuities like this on an SPIA, the odds are, based on history, mother's going to outperform the actuarial table generally. So far, they haven't got the female right on this issue. So I'm looking at people sitting in one of our nursing homes that Ken and I both know about over in town, and there's gals in there in their 90s and a couple well, not tricentenarians anymore, but they're in their hundreds, right? And I mean, they're taking it to the bank. And I'm sure the RLE, their life expectancy was somewhere around 85.
Right. So the distinction is we had combination annuities where we regrew the principal. Don't confuse this strategy. Now we're focused on the lifetime income benefit rider to save the day and allow for higher income in the earlier years and the use of return of basis. Let's shift over to, that's for people who want income. But as the newer strategy we're talking about is the Obamacare is either the upper middle class, depending upon your definition, or the wealthier people. And so now we're talking about helping them with these same strategies. Well, they may not need the income, and there's 2 possibilities. They may not need the income, but they like the idea of having a safety net. So doing a high cash value life insurance product with a decent death benefit gives them the comfort that they have access to it, and they can get it tax-free, as long as they keep the contract in force for life. Or they could design it to max the legacy or the amount of death benefit to the children and or charity for that matter, right? Because once they're through with it, they can give it away. And then our chronic illness rider is, okay, we're designing this, Mr. and Mrs. Client, for your kids, maximum death benefit, but just in case, what are our big expenses or big surprises? They're medical in nature generally, right?
Absolutely.
So with the chronic illness rider on there, that takes care of that and said, hey, you can go for the whole shebang here. You can go and get the maximum death benefit legacy to the kids, just write it all the way, and we're going to throw that chronic illness rider on it. So if you need that money for medical care, you can turn that on. I almost said puppy again. You can turn that puppy on again. You got me self-conscious. Anyway, we'll turn that puppy on again, and so we can cover all of those things. So we can have income, we can have chronic illness, or we can have death benefit, and we can design that life policy to customize it to what our clients tell us they want.
And it sounds like we have some flexibility to pivot here.
We have a good deal.
I mean, we don't have to make all these decisions today,
right?
On some of this, right?
That's
I mean,
right.
some of this we can actually pivot on it. Well, I just want you to know you're in the dog pound with Steve and Ken, because now we're selling puppy strategies. Wow, Ken, I have to tell you, you're just bringing new wave dictionary to me on my econ and financial nomenclature, I have to say. Well, you can watch our show and all our shows, of course, at www.brokersalliance.com. Just come on our homepage and hit the red on-demand button. And remember, you've been in the zone with Ken Davis. We've been in the doghouse doing the puppy thing. We'll see you tomorrow.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.